Hi everyone, it's time for the 2015 forecast. I'm Barry Habib and we're looking into the crystal ball and see where things are headed for this year. More importantly, what are some of the drivers that can have a big impact this year. So let's take a quick look. We'll go right to the slides for this edition of Presentation Expressway. Here we go. Forecast for 2015, and our predictions begin with where we were last year and how we fared. We had a really big call on 10-year Treasury note, which was at 3%. We saw it going to 2%. Not a lot of people were in our camp, but we did correctly nail that one. We also nailed the month in October, and that was because that was when QE was ending. We've had previous experience with that. We remembered that and served us well. We did correctly forecast home price appreciation to be at 5% to 2014. Hit that one right on the nose. We were correct in anticipating some higher stock prices, but we were incorrect in forecasting that stock prices would struggle during the last 2 months. We thought it would be difficult after QE ended for stocks, and we were way off base on that one. Stock prices indeed finished the year very strong. Sure, there were a couple of weeks of volatility. When we were in October, we thought we were really going to dial this in when stocks declined, but they regained their footing and finished very strong, so we missed that prediction. But we also did predict, and this was an important one, that the U.S. dollar would strengthen against the euro and the yen, and that would help lower interest rates. We're going to talk more about that in this prediction, this forecast, because that was a very good prediction, and it sure did come to be. Let's take a look at the dynamics for 2015. The U.S. dollar strengthened significantly, as just mentioned. It will continue to gain against other currencies. The U.S. economy is more attractive. The European Union needs to increase their QE efforts. Japan's all in on trying to create inflation, so we should see a continued strengthening of the dollar. Inflation, well, there is none. There's fears of deflation, and that's going to help interest rates as well because there's no inflationary pressure that's out there. Very low energy costs and limited wage pressure. This is acting as a ceiling, so to speak, on interest rates. It's difficult even for the Fed to move in the absence of inflation for fear of deflation, which is a pretty bad thing. A very strong dollar does create some headwinds in real estate markets that have been dependent on foreign buyers. Because, look, when foreign buyers on the East and West Coast come in and their currency is stronger, when the euro was at 140 not too long ago, now it's at 120, meaning that it takes $1.40 to buy 1 euro, now it's $1.20. Well, you think about it, that means that the United States real estate properties to foreigners appear to be cheap if they're used to having euros. It's just like when we go over to Europe and we have dinner. If you've done that and you get the bill and you're like, whoa, it's very expensive with that currency conversion, making it more expensive for the same type of thing. And the same thing on the West Coast, a lot of Asian buyers coming in, and they have been able to get things, so to speak, on sale. But now that the currencies have changed and going to get worse, could create some headwinds in those markets. The big driver right now, and what I think will be the big story for 2015, is going to be oil. There's a big argument in oil. Some people are saying, hey, oil prices going down as much as they have is good. Who doesn't like saving money at the pump? It's great. Extra disposable income. It's going to be great for the economy. Because if people aren't spending on gas, they'll spend it somewhere else. Okay, I get that argument. And I love the fact of lower oil prices helping out in these areas. But we can't be silly and think that's the only argument. Unfortunately, that's what the media sees, and that's what so many so-called experts are claiming. But the real deal here is the fear, in my opinion, of the negatives on oil. Let's take a look at the other side of the argument, the ugly side of it. You know, energy producers are unprofitable in the United States if they can only sell oil at these low levels because it costs them more to recover it and produce it. And while they stay open for a while because they've wisely hedged, just like we hedge in the mortgage business, and while they continue to plug away, eventually there comes a time when you're unprofitable and you have to shut down. When you do shut down, you can't open back up quickly. The problem with this is that we can see a company or oil rig shutting down and then letting people go and not wanting to open up until they saw oil prices not just at levels that they were profitable, but far beyond that because they wanted to maintain some cushion just in case. I think that these rigs will go offline for longer than people are seeing, and the job losses could be significant. Let's face it, the largest contributor to job growth during the economic recovery has been the energy sector. 40% of all job creations coming out of the energy sector. And losing that engine of job creations is going to take a bite out of the economy. In addition, housing has benefited. You know that 11 of the top 12 appreciating real estate markets by a percentage basis are energy related. And look, the depressed oil markets can create some havoc in areas like Russia, Venezuela that are very dependent on these oil revenues. It could create unrest. And then, of course, low inflation, deflationary pressure. We actually think that oil has not seen the bottom yet. We're looking for oil to bottom out at around $40. And that's going to be for a bottom in oil prices at around $40. A significant drop from where they are right now. Stock market, look, I know a lot of people think stocks are going to continue to roar. I just think that there's going to be a lot more volatility. Let's remember, what are the changes from last year to this year? No more quantitative easing. So there's more volatility there. Stocks have gone up so much that the price to earnings ratios have gotten a bit ahead of themselves. They're very high. And the positive argument for stocks is, hey, where else do you put your money right now? With very low yields out there, the stocks still look like a place to be. We see stocks modestly higher, but extra volatility, a lot of volatility there. The Fed, let's talk about the Fed. Everybody's saying that the Fed's going to hike rates in 2015. I'm not so sure. Because, first of all, look at the composition of the Fed. In 2014, 4 hawks, 5 doves. In 2015, this is voting members now, 2 hawks, 7 doves. The Fed fears deflation. There's no inflation in sight. The economy is improving, but it's still vulnerable, still tentative. Look, everybody is calling for the Fed to hike rates up to like 1.5 points. It's a lot. We are making a bold prediction here. Fed stays on the sidelines, maybe one small rate hike. We do not see the Fed going through with this huge amount of rate hikes that everyone else is forecasting. Housing, near and dear to us. We nailed it last year. We nailed it the year before. We called the bottom exactly when it happened. So we've had a hot hand in forecasting the housing market, saying at the beginning of 2012, that was the turning point. 2013, we said 15% appreciation. Last year, 5%. Nailed it on all of them. This year, 3.5% to 4% appreciation, and here's why. Rents are making housing more attractive because they've been rising. Most parts of the U.S. are still affordable. Some areas, of course, have gotten a bit ahead of themselves. Underwriting on loans is still tough, but slightly more relaxed. Rates will be really good, and that's going to be the big plus here. By the way, we wrote it twice. It's so important. Underwriting's more relaxed, but still tough. We wanted to show you twice, I guess. All right, so 4% appreciation after 5 years is something that people don't often look at. They say a 4% appreciation, it doesn't really appear to be that big of a deal, but it can be. If you take the median household price right now, $205,000 and change, and added just 4% appreciation and compounded it over 5 years, that same home would sell for $240,000 or $35,000 more than where it is now. Now you have to take a look at this relative, not just to the home price, but to your down payment. If you put 10% down on that home or $20,000 down, that 35% difference, that's about 180% return on your money. And if you put 20% down on that property, so 10% down or $20,000 investment, you've made $35,000 over 5 years. If you put 20% down on that home, or $40,000 and made $35,000, you've made about 85% on return on your money. It's a huge benefit to the amount of appreciation or gain on your initial investment. Interest rates. Let's talk about interest rates. The Fed's situation is a win-win. The Fed's position is a win-win for rates because if they hike rates, probably the stock market gets hit, and past history has told us that when the Fed hikes rates, mortgage rates actually decline as stock prices slow, and that money goes into the bond market. We also think that if the Fed stays on the sideline, that keeps interest rates low as well. So it's almost a win-win for rates as far as the Fed. Low oil prices, as mentioned, no deflation, slower economic activity. Let's give you some context on this. Back in August of 2008, just before the Eagle Ford Shale well was drilled in South Texas, The U.S. imported 181 million barrels a month of oil. 6 years later, 87 million barrels of oil per month. That's 94 million barrels of oil per month difference, which that money is being pumped into the U.S. economy. And look, in the last 6 years, we're using more oil, not less, because our population has grown by a significant amount. That tells me that we perhaps have 100, 110 million barrels of oil in this country every month that our economy is benefiting by because of the drilling that we've done here overall. This is something that if these rigs start to close, if this market starts to slow, it will have a negative impact on the overall economy, and it will help interest rates. And when you take a look worldwide, look at our yields on rates. Compare that to Germany, France, Spain, and Italy. And you can argue, especially in the case of Spain, France, and Italy, our economy is a lot stronger, perhaps even than Germany's too, and they're offering this. And how about Japan? Japan is less than Germany for their 10-year paper. Okay, these are all 10-year yields. Our dollar is going to continue to strengthen as well. And when our dollar strengthens, there becomes a currency play. Take a look at this. Now, we've shown you this as MBS Highway subscribers in the past, but take a look at one of the reasons why rates could go lower because of the currency. Let's walk through this step by step. Investment choices for a foreign investor, someone outside the United States. They look at the German Bund today at 52 basis points. They look at the U.S. Treasury note at 2.1. And their investment of 100,000 euro would give them in a German Bund a yield of 52 basis points, or half of 1% roughly. So if you're someone in Europe and your money is in euro, and you say, I want to put my money someplace safe, you invest in a German Bund, and assuming there's no price movement in the German Bund, your yield is a half of 1%. So a year later, you have 100,520 euro. Okay, not a lot. But if you said, wait a minute, the US, I can get 2.1%. That's pretty much 4 times the yield. That sounds good. But here's the real play. It's the currency play. And some of you might have recalled, we talked about this, and we said when the ratio of US dollar to euro was 132, we said we see it going to 120. Well, guess what? We hit our target exactly. We said that back last August, and here we are already. We've hit that target. Well, here's what we see happening in the future in 2015. We see the US dollar and the euro going to parity, which means $1 is 1 euro. So let's go through that equation again. You take your 100,000 euro investment and you say, I want to do it in treasuries, which means you have to convert US treasuries. You have to convert your euro into dollars. So today, 100,000 euro equals 120,000 US dollars. At a yield of 2.1%, a year later, you have 122,000 US dollars roughly. Now, if you say I want to bring this money back a year later to Europe, and if what we think is going to happen indeed happens, the US dollar drops to parity, so $1 is 1 euro. The investment that you made in euros of 100,000 euro, you bring back 122,000 euro, which means that you've made 22% instead of a half of 1% on your investment. 44 times the investment. We're not the only ones seeing this. We think a lot of foreigners are going to be continuing to have an interest in investing in U.S. treasuries and U.S. mortgage bonds. That should keep our yields low. How low? Well, let's tell you. Rates are going to be lower in 2015, and this is going to offer a great refinance opportunity. We see the 10-year Treasury note reaching 1.5% or maybe lower, maybe approaching 1%. That means 30-year fixed mortgage rates will be below 3.5% and approaching 3%. This is obviously a very bold prediction and a very bold call, but similar to in the past, we're no stranger to making some bold predictions like we've done here. I think that we need to watch these dynamics, and I wouldn't be surprised if sometime during 2015, that 10-year Treasury is somewhere between 1 and 1.5%, and interest rates are closer to 3% on a 30-year fix with 0 points. All right, we hope, most importantly, that the prediction for you is health and happiness and prosperity and a year filled with lots of laughs. We'll talk to you again. Thanks. Bye-bye.